Hi, my name is Arifa Shaza binti Muhammad Rosti. I'm the first presenter from Group 4, which is we do an assignment about current issue on personal planning about consumer credit. Okay, do you know what is consumer credit? Okay, consumer credit is the borrowing of money by individuals to finance purchases of goods and services. It's a fundamental concept in modern economics, allowing people to acquire items they might not be able to afford upfront. However, responsible use is crucial to avoid financial strain. Okay, by understanding the concepts and principles of consumer credit, you can make informed financial decisions and leverage credit as a tool to achieve your financial goals.
Hi everyone, my name is Nur Maizura binti Mahdi Elaisaridi, and I will be presenting to you guys in the topic of the purpose of consumer credit. So consumer credit is a vital component of modern financial system that offers individuals and economies of a range of benefits that contribute to economic growth. So one of the primary purposes of consumer credit is to enable individuals to make immediate purchases. So instead of waiting up to save up the necessary funds, consumer can use credit to acquire goods and services when they need them. This is particularly important for essential items such as home appliances, vehicles, and also medical expenses. So the next point is the purpose of consumer credit is to boost consumer spending, which is a significant driver of economic activity. When consumers have access to credit, they are more likely to make purchases, leading to increased demand for goods and services. In this way, consumer credit acts as a catalyst for economic expansion and also prosperity. Moving on to the next point, which is financial flexibility. So financial flexibility is another important purpose of consumer credit. It allows consumers to manage their cash flow more effectively by spreading out payments over time. This flexibility is particularly beneficial for managing large or unexpected expenses such as home repairs or medical bills without depleting savings or cash reserve. Using consumer credit helps individuals to build and improve their credit history. So a good credit history is essential for securing a favorable terms on future loans such as mortgages, car loans, and also personal loans. Additionally, a strong credit score can influence rental agreements, insurance premiums, and even employment opportunities. So the fifth point here is credit cards, a common form of consumer credit, will offer convenience and security for transactions. They eliminate the need to carry large amounts of cash, provide fraud protection, and are widely accepted globally. This convenience makes everyday transactions easier and safer for consumers. Additionally, credit cards often come with benefits such as rewards program, travel insurance, and purchase protection, adding further values to their use. Last but not least, consumer credit promotes financial inclusion by providing access to financial services for individuals who might not have significant savings or assets. This is especially important for low-income individuals and those with limited access to traditional banking services. By offering credit, financial institutions can help these individuals manage financial emergencies, invest in opportunities, and improve their quality of life. Financial inclusion, in turn, supports economic stability and reduces inequality.
Okay, I will present about the advantages and disadvantages of consumer credit. First, the primary advantages is convenience. Convenience is they allows individuals to make a purchase that time without needing the cash. This happens actually when you need to buy a big expenses. Okay, another point is buy now or pay later features. Buy now or pay later. It enables consumer to have a goods or services that time but cut or spread the cost anytime or over time when needed. This can be particular managing for their financial emergencies. The third one is a positive credit history. This happens if you use the credit cards and loans responsibly and making the timely payments accurate. You will get the history of financial in a good score, established to good scores. Additionally, and last but not least, for advantages, the credit cards offer many rewards and benefits. Can include like cashback, travel point, and other various perks that can add value to everyday purchases. So for a consumer who manage their credit card responsibly, this reward can provide a sustainable benefits.
Hi, now I will present about disadvantages of consumer credit. Okay, despite its advantages, consumer credit also has disadvantages, isn't it? So one of the major is high interest rate and fees. If credit balance are not paid in a full each month, the interest can accumulate quickly, significantly increasing the overall cost of purchases. Late payment also can incur heavy fees, adding to the financial burden. So another concern is the risk of debt accumulation. Over-reliance on a credit can lead to the substantial debt, which can be challenging to repay, especially if they're compounded by high interest rate. These debt accumulations can negatively impact on individual financial health and future borrowing capabilities. Another point is the impact on credit scores. Missing payments or exceeding the credit limits can lower the credit scores, making future borrowing more difficult and expensive. A poor credit scores can affect not only loan approvals but also interest rate and terms offered by the lenders. Furthermore, the availability of credit can lead to overspending. This ease of accessing credit may tempt individuals to purchase beyond their means, leading to the financial instability. This can create a cycle that is hard to break. And last but not least is managing consumer credit lead to the stress and anxiety. The pressure of making monthly payments and handling debt can impact an individual's overall well-being and causing significant mental and emotional strain.
Okay, now I want to inform a lot of type of credits. First is credit cards. Credit cards allows consumers to make purchases up to a predetermined credit limit. Number 2, personal loans. Personal loans are typically unsecured loans that individuals can borrow from various purposes such as home improvements, debt consolidation, or unexpected expenses. And number 3, installment loans. Installment loans involve borrowing a specific amount of money and repaying in equal monthly installments over a set period. Okay, number 4, mortgages. A mortgage is a loan used to finance the purchase of real estate, typically a home. And number 5, lines of credit. A line of credit borrowers access to a predetermined credit limit, like a credit card, but typically with lower interest rate. And number 6, retail store credit. Retail store credit refers to credit accounts used by specific retailers or stores that allow customers to finance purchases directly from them. Number 7, payday loans. Payday loans are short-term, high-interest loans typically used by borrowers who need quick cash before their next paycheck. And last but not least, 4 types of credit is secured loans. Secured loans are backed by collateral such as savings account or a vehicle.
So I will move to the current issue of credit scams. Credit scams have become a pervasive issue affecting a wide range of individuals across different demographics. Understanding the current landscape of credit scams and their impact is crucial of developing effective prevention strategies. One of the primary issues is the lack of awareness among the consumer regarding the tactic used by the scammers. Many people do not recognize the signs of scams until it's too late. This lack of awareness makes individuals more susceptible to deceptive practice such as phishing emails, fake websites, fraudulent phone calls, which can easily lead to the theft of personal and financial information. Additionally, credit scams disproportionately target people with low incomes, minority groups, and older adults. These populations are often seen as more vulnerable due to limited access to the financial education and resources. Scammers take advantage of these vulnerabilities by offering fake loans, credit repair service, debt relief programs that promise quick fix but result in further financial harm. Another significant issue is the rise of identity theft. Scammers use stolen personal information to open the credit accounts, make purchases, or take out loans in someone else's name. Victims of identity theft often face long and complicated processes to restore their credit and reclaim their financial identities. Moreover, online and digital platforms have become fertile ground for credit scams. The anonymity and reach of the internet allows scammers to catch wide net, targeting individuals through social media, emails, and online advertisements. This platform can make it challenging for consumers to verify the legitimacy of offers and services, increasing the risk of falling victims to scams.
Here is a statistical information. We get 3 statistical information, which is first of all is the problems extent. We get this information from worldwide losses, cannot present, CNP, fraud and the victims. The second one is current concerns. We get the information from growth of CNP fraud, data breaches and account takeover ATO. And last but not least is getting further details. We get the statistical information from getting further details, which is Federal Trade Commission's FTC and Experian. Okay, you can see 3 types pictures from at the above to more detail about statistical information.
The conclusion for overall the credit scam is the bottom line is to fight the credit fraud. We need the concerned effort from individual, community, financial institution, and policymakers. By raising awareness, increasing education, implementing strong preventive measures, we can better protect consumers from damaging their effects of credit frauds and from successful scammers and foster a safe financial environment for all. This will protect everyone, the community, from being the victims of the credit scams. That's all. Thank you.
So here comes the recommendations for innovative solution in solving these problems with credit scams. So credit scams are a pervasive problem that can affect anyone, from individual consumers to large financial institutions. While complex and highly advanced technological solutions are essential, there are also simple measures that can significantly reduce the risk of credit scams. So one of the simplest yet most effective ways to combat with credit scams is through ongoing consumer education. Financial institutions should regularly inform their customers about common scams and provide tips on how to avoid them. This can be done through newsletter, emails, social posts, and also informational brochures. Next, financial institutions should encourage customers to use strong, unique password for their accounts. Password should include a mix of letters, numbers, and special characters, and be at least 8 characters long. Regular prompts to update password can also enhance security. As an example, implementing 2FA, which is two-factor authentication, adds an extra layer of security. This simple measure significantly reduces the likelihood of unauthorized access. Moving to the next suggestion, financial institution can offer transaction alert services that notify customers of any activity on their accounts. These alerts can be sent via SMS or email and allow consumers to quickly identify and report unauthorized transactions. Encouraging consumers to regularly monitor their account statements can help detect fraud earlier. Finally, implement of regular training for frontline staff on how to recognize and handle potential credit scams is crucial. Staff should be aware of the latest fraud trends and know how to assist customers who may be victims of scams. Providing excellent customer support can help consumers navigate the complexities of fraud prevention and resolution. That's all from me. Thank you.